Good morning, everyone. I'm Vince Lancy, and this is the Market Rundown. Today, we will take a look at a new report by Goldman Sachs that features gold in its title and discusses gold in context of other commodities, and a quick preview at what is shaping up to be a disagreement between big banks on what they think the Fed will do in September for rate cuts. And the disagreement is rooted in this Friday's payroll number. So one bank will be right and one bank will be wrong as of Friday, 8:30, it seems. Okay, so there's the front page. Goldman stays golden. Um, let's go through the markets first. The dollar is down 10. 10-year yields are down 2. The S&P 500 is down 19, 18.8. The VIX is 22.78, up 2 percentage points. Whoa, let me take a look at this. Yeah, that's yesterday. Gold is down 296. The silver is up 2 cents. Copper is down a penny, no follow through, continuing lower, I should say. The gold silver ratio is flat to slightly lower. WTI is up 62 at 71.51. Natural gas is up a penny. Bitcoin is down 960 and Ethereum is down 28. Platinum, palladium are mixed. You can see the numbers there. Grains are mixed. Corn is unchanged. Wheat is up. Soy is down. You can see the numbers there. Okay. Before we get into the meat of this VIX thing reminded me of something. Yesterday, I got a call from a subscriber, or a text, I should say, and he asked me to give a rundown on what happened in equities yesterday. And why don't we just go through the markets, what happened yesterday? The dollar was stronger yesterday as people flew to safety. 10-year yields dropped yesterday as people flew to safety. Flew is a bad word, but you get my point. The S&P 500 was decimated, and the heart of that was there was one real trigger for it, although I wouldn't call it a reason. The ISM PMI manufacturing data came out yesterday at 10 a.m. And the manufacturing data showed, not crazy, but showed a distinctive slowdown in manufacturing. Manufacturers aren't making as much stuff, and a distinctive uptick in manufacturing costs. Those that are making things are spending more money on natural resources to make them. And so that was it wasn't deep, but it was a very clear stagflationary impulse. And since the markets are looking at the economic data right now more than, say, inflationary data, the markets were poised to sell off. I mean, look, everything's overbought, and I think it's, without being a doomer on this, for the market to look at that data and react the way it did says that the market is too long going into this Fed rate cut thing, and that if the non-farm payrolls do not really surprise lower, if unemployment doesn't continue its trend of increasing, then the stock market could really take it on the chin. I don't know, but we'll talk more about that tomorrow. Gold, did you hear my voice crack there? Gold, let's go to the daily. It's going to be easier to see in a daily. Gold, and without my lines, continues to get sold along with stocks and continues to get bought. Now, the levels matter to a technician. For me, they matter because the buying type matters there. And, I am not bullish this time of year. So I am getting my sell-off, but this is not a sell-off that's cascading. This is a sell-off that's getting caught and caught and caught. So if this market were to get back into this trend, this trading rate here, put my lines up again, maybe that'll help. Right. The market, here we go. We're above Michael Oliver's line again. We're back above that line. If we get back into this line here, I'll just draw it. Right. If we get back in here again, uh, I don't think this high is gonna hold. It's crazy, but this is what the market's doing, despite what I feel and all my experience. So gold is being sold in sympathy with stocks. It is sell season. It is September. It is a time of year where people that want to sell are a little bit more impulsive than people that want to buy. And you're seeing that. Anyway, let's see what happens at 9:30. Let's get to the meat of it. Goldman stays golden. Okay. Today we'll talk about Goldman going gold. I think that's their title. And we'll also touch on the MS and Citibank difference of opinion on Fed rate cuts. There's the front page. Plenty of stories. Bloomberg sell season started. That's yesterday's broadcast. The illegal immigration comment and Zoltan Hartnett's flow show. All right. Now, this morning we just put out a report called Goldman Stays Goldman. It should be in your mailbox if you're a subscriber as of about 6:50. So I want to walk through that a little bit and share it with people that like to listen to videos. Okay, so premium analysis, Goldman Stays Golden. Title, Go for the Gold, September 2nd. A brand new report from Goldman Sachs titled Go for the Gold is out. The best intro we can give is this audio one sent out yesterday. You can click on that link for that. As to our own analysis from Goldman Goes, that's the name of the report we just sent out. Gold remains the bank's preferred near-term long position with a maintained price target of 2,700 per ounce by early 2025. Their analysis attributes this bullish outlook to several factors. Central bank purchases have tripled since mid-22 due to fears of U.S. financial sanctions and sovereign debt concerns, which are expected to continue. Imminent Federal Reserve rate cuts are likely to bring Western capital back into the gold market, and gold's ongoing value as a hedge against both geopolitical risks and macroeconomic uncertainties is underscored as a compelling hedge for maintaining long positions. This is all in context of their underweighting of industrial commodities as their 2024 deficits basket. That's a industrial commodity deficits basket is closed with an 8% gain as cyclical support softens. Okay, so we're going to go through what this means in a little bit. All right. We'll look at this chart as well. But here's the bottom line. Gold is the only game in town for commodities the next month or so at least. Context matters a great deal this time of year on reports like this. We go into that in our analysis in great detail. The report itself, the report covers many commodities. And I think what happened is they booked a gain in a basket for their clients called the deficits basket, which was predicated on the fact that there's deficits in copper, there's supply deficits in copper, there's shortages in oil, there's shortages in natural gas, actually, not oil right now. Shortages in natural gas, and that was their reason for being bullish. And that they have an 8% gain in that for themselves and for their clients. They close that and booking a profit, and they wanted to probably address what they thought people should be doing or what they thought their clients should be doing, and that is cyclical support for industrial commodities is softening. But don't lump gold in with that. Right? And then they go through the reasons why your money should be in gold. I think it's interesting on several fronts. One is that the bank is using the gold market as a money market for commodity trades now. So, and that's quite bullish. It's kind of like flight to safety in commodities, buy gold. Flight to safety in geopolitical risk, buy gold. Flight to safety in U.S. banking risk, buy gold. I mean, there's just becoming more and more reasons to buy gold as a safe haven. They're not even saying to get long it. They're saying to maintain your position, which ultimately means get long it a little bit. Anyway, so we'll touch a little bit more on that in a second. Here's the chart. The chart might not be big enough for you, but let me help you out here. Exhibit 6, we see value in long gold positions given higher central bank demand and hedging value against geopolitical financial shock, sanctions, debt fears, tariffs, Fed subordination risks. Fed subordination risk, great phrase there. They've used it before. Fed subordination risk means they're saying that the Fed, as time goes forward, is going to become subordinate to other parts of the government. So less important, more under the thumb, less of an effect. So it's kind of like the Treasury asserts itself while the Fed is diminished in importance. The second thing about this chart I think is important is they are now sharing, maybe they've shared it before and I missed it, but they are now sharing. See the light blue area? The light blue area is unreported gold net purchases by central banks. Unreported. If it's unreported, how do they know it? Because they're a bullion bank. So they're starting to show, the door is opening for everyone now. It's no longer reported central bank holdings. No, it's unreported, right? It's what they're not saying. When you say unreported, you're referring to China. You're referring to BRICS countries that aren't really involved in the Western reporting system. And you're probably going to be seeing I'm not sure if they'll show up, but unreported by Western banks. So put it this way, the unreported in between 2010 and 2022 is that little tiny blue sliver, light blue sliver. And between 2022 and 2024, it's 200% of the buying. So we bought this, we cheated and bought that too. We bought the same amount. We also cheated and bought twice as much as that. Okay, so they're quantifying the additional boost to gold price. Again, what did I say about this a couple weeks ago? The banks are coming up with new models to tell their clients it's okay to buy gold. And that is central bank buying. So now they're saying this is how much central banks are buying, and this is the contribution to the price of that. And that's the additional boost to gold price. Okay, so it's a very good report. The context matters a lot, and we recommend you read it, especially this time of year. Okay, next, quickly, Morgan Stanley and Citibank differ on Fed cuts. Here's some bottom line. It's under news, but it's going to be news, right? So we'll talk about it more tomorrow. Morgan Stanley says 25 basis points this December, and it's based on the payrolls unwind that we had in July, is a temporary weakness in Texas, motor vehicles, and some other exaggerated July slowing. We expect the reacceleration in payrolls to leave the Fed cutting only 25 basis points in September. Citibank says Citibank's been more aggressive to begin with. Okay, they were the first to say 7 rate cuts. They were also the first to say 50 basis points in the next 2 cuts. So here we go. August unemployment data will be the pivotal factor determining whether Fed officials are likely to start the rate cutting cycle with a 50 or 25 basis point cut in September. True. We expect a report largely similar to July. We expect this to lead the Fed to cut by 50 basis points in September. Simply put, those temporary layoffs because of the hurricane in Texas, they believe they're more likely to be permanent, not temporary. More on that tomorrow. Moving on. Very important to have the banks disagree on a rate cut this close to the rate cut. Now, of course, we might not have a rate cut. Wouldn't that be a kick in the ass, right? That's a hat tip to Steve for reminding me of that. Data on deck, today's Wednesday, factory orders. It's a continuation of the ISM yesterday. Okay, so ISM related to ISM and then ISM, which is PMI. All right, Friday's the big number, and there you have it. Here's the post. I'm going to click on it and show you the contents, table of contents, right? 1,200 words, key charts. And see this area here? Look, a lot of people are going to start writing about this report, and some have already started writing. No one's going to have number 7, number 8, and number 9. And This is dry professional analysis that we wrote or coverage of their report. And this is experience and context. That's extremely important this time of year. Final word, don't judge a book by its cover. That needs to be read if you're looking for guidance from reports like this. Okay, again, it's a good report. I'm Vince. Let's check the markets again and be on our way. Okay. What I want is gold to sell off, because I would like a nice entry level to buy going into buy season. What I'm getting is a ratcheting lower in sympathy with stocks. Boom, boom. But that's a trend lower. You can't argue that. But I'm seeing we'll start back here. Start with the first dip. Nothing special. Nothing special. All right. All right. This is the knife being caught. This is the knife being caught again, twice in a row. And I think if you go to the 4-hour, if you remember what I said yesterday, I said, where was that? On this move down, starting from here to here, it was like this. Caught the knife higher. We don't care. Now we resume the downtrend, right? All right. No catch. No catch. Continues. Catch. Hard rally, not extremely hard, but hard rally. Catch. Harder rally so far. Okay, so it's like this market is going lower and running out of steam lower. Look at your RSI and your MACD to see if I'm crazy or not. But look, again, I'm not bullish. I want it to go lower so I can buy it. Okay. These lines here, it's a lot of lines. All right. There's Michael Oliver's line, which really is a champ of a line right now. Right. If we settle above this line again with 3, 1, 2, 3 wicks below it, then we're in good shape. Again, if we crack this line on a settlement basis, I fully expect 24.50 to trade. If not, then I won't get my dip and I'll be bitter because the market will start buy season without really selling off at all during sell season. All right. I'm Vince. Gold is down 4 and change. Silver is down 2 cents. Remember, silver's caught in that industrial market thing. So I want to say this, despite silver being sold so people can accumulate gold, despite silver being not being bought by central banks, despite the fact that it's largely industrial in its purchase right now, it ain't copper. Show you what I mean. Here's the hourly for silver, for copper, and there's the hourly for silver. They look the same. When you look at days like this, right? Silver there, right? Silver from here to here is down 32 to 28, so down $4. 10, 12%. Copper from here to here, from 512 to 40. That's down. What's a buck over 5? 20%. Okay. Silver's getting dragged down by copper. And gold is literally holding silver up because of its precious status. So look, if gold doesn't drop, then silver's probably going to rocket during buy season. I'm not sure, but that's what I'm looking at. Take care.